Alrighty, folks, in video number 1, we took on the hot topic in non-zero chance of the 10-year note hitting 6%. As you saw in that video, or if you haven't, go back and watch it. The ending is not pretty, but plenty of opportunities will be made. This video, we're going to talk about what happens if the 10-year note goes sub 4%. On a like video number 1, we will assume that happens in the next 60 days or so we can put a time box on this. All right, what do you think? Where do we start this story? In video number 1, we went to the banking sector. Where do we start with this one with the 10-year note sub 4%?
Well, I think we could say the banking sector would stay pretty stable. They would be happy to lend again.
Yes.
So lending could loosen a little bit because it could reduce the chance of a deeper recession. And banks, commercial real estate investors, and companies having to refinance debt at higher for longer rates. So if rates go down, it's a big sigh of relief for everybody, every investors and the banks. Lending continues to go. We get happy. I go refinance everything that I have at the lowest possible rates. And I lock them in for 7 to 10 years instead of for 5. I pay a little more to get a longer lock because we've lived this story and it could repeat again.
We've been here. Yes.
And once I do that and I refi my debt and get my debt payments down, my income will go up and I'm going to go shopping. I'm going to go buy a whole bunch of real estate.
Yeah. It's really funny when I think about the different story. I guess the first thing I actually think about isn't the banking sector this time. I think about why. Why would rates go to sub 4%? And I think the thing that jumps out to me is, frankly, this sell America trend, which certainly seems to be playing out in the gold and Bitcoin market. And again, we're recording this on the 22nd of April, where gold exceeded 3,500. I think what would happen if we go sub 4% is sell America is over. Which really means, I think, that this tariff kerfuffle is behind us. And we are once again, the shining beacon, or at least becoming that again, and people want to work with us. I think there's a fair amount of somewhere between distrust and unhappiness with our trading partners, allies, friends, and foe. Yes. And if we go sub 4%, again, it tells me that that's, for the most part, behind us. And I would like that. Either that or it's not, but it puts us in further into and faster into recession finally being here. And recession could be worse because the Fed is, right now, Trump and Powell are at odds, right? Let's just, to put it lightly. But if we have deep recession, it's the only way that Powell will cut rates in terms of the Fed funds rate. And even though we're talking about the 10-year, which isn't exactly correlated to the Fed funds rate, the Fed funds rate will impact what investors are willing to lock up their money at in terms of what yields they'll take on a treasury, because they look at the opportunity cost between the Fed funds rate, investments that are based on that, using debt to create spread versus the 10-year treasury. And so having a deep recession could cause treasury rates to fall as well as the Fed funds rate. But if there's tariffs, war still ongoing at the same time, you could see the Fed funds down and you could see the treasury, teetering. So I hope it's that the tariffs are basically all down, that everybody's negotiated and we have really low tariffs across the globe, and sell America's over and people are buying treasuries and that's pushing yields down. But it could be a recession that does it as well. Yeah, because again, we've seen so many things that have been historical trends that part of me thinks that even if the Fed cuts today into this kerfuffle, rates go up again, which is what happened. It's not supposed to happen, but it certainly appears to happen. So again, I think there's so many things that are just not normal today, and that's why I think sell America. I just think there's foreign entities that are going, hey, we were 60% in on America, we're going to go to 52%. So they're not dumping everything, but they're just lowering their allocations. But when you're the biggest, baddest, market on the planet, an 8% adjustment across the board, it's going to be felt. Assets are being sold.
Yeah, absolutely. And when rates go down, asset values come back up. And so it's good for the stock market. It's good for investors because so many things that we invest in today, and this is where people don't really realize the correlation between treasuries and real estate, for example, especially commercial real estate. The value is really just a spread on better return for the risk that you're taking above the 10-year treasury. So if the 10-year treasury goes down, you're willing to take a lower return on your cash to buy other things, other businesses, commercial real estate, for example. And so because you're willing to take a lower return, a spread over that treasury, the value goes way up on these assets. And so it's going to have a wealth effect for those that have assets, and it's going to make the value of those assets go way up. And then if we can refinance them at low rates, we get to cash out. We can take advantage of some of that equity, and we can go shopping. And so, it's a really good thing. There's consequences of rates being too low, which, is long-term inflation. And we've seen that, but there is huge opportunity for us to tap into some of those capital gains, whether you're selling an asset or whether you're borrowing against it and taking the equity. But it's a real opportunity for growth. And it's why, when you're in a recession, the Fed cuts rates because they want you to invest in growth personally, in your businesses, in your communities, because it gets you out of a recession. It sparks a recovery. So if rates are that low, they're there because things are stabilizing. And they're not great, but there's hope for expansion. And then you have pro-America, invest in America again. In every way possible. Companies, funds, commercial real estate investors, employers, small business. So it means not only stop selling America, but start doing what you can to invest in America and grow your assets and your wealth.
Yeah, I think that's also where I go. And like video number 1, where I kind of went to the government in the national debt as my second step, I'm going to go there again and realize that where we are sitting now, thanks to Janet Yellen with, I don't know what it is, $6-7 trillion in short-term paper, a sub 4% 10-year would allow us to term out the debt at lower rates, buy significant time, and frankly, bend the curve, right? Ex-defense interest payments now are the second largest payment. And it's crazy. If we could get to a point where we could, take that down a notch, that is a good thing for all Americans, and frankly allows us to get to the second step, right? The Trump administration, took on the tariffs and the ugliness first, but that buys time to get to the pro-growth, lower taxes, lower regulation, and really could set up just a rebound, just a shot of growth in 2026. So the first thing I think about when I see those, sub 4% is 2026 is going to be very different than, the rough start of 2025.
Yes, absolutely. And, that bending the curve, a lot of people don't really understand that, or yield curve control. Basically, the Treasury is basically trying to say, we're going to issue longer term debt at these really low rates so that we kind of know what our interest payments are going to be on that debt. And so that they could get those interest payments down, because if they can get the interest payments down, they have a lot more wiggle room in the budget for spending on other things that we need, like defense spending or Social Security and Medicare, the things that we call, oh goodness, what is the term? I haven't had enough coffee yet this morning. But essentially our payments that we have to make to Social Security. Entitlements. There's the word. Yep. Thank you. It gives you more room for the entitlement spending and the other things that the nation wants to focus on if they can just get that debt down. So, a lot of this discussion about, hey, Fed, you need to cut rates. It's really about the bond market. It's about the Treasury rate, because that's what the government needs to be able to control as much as it can. That's what yield curve control means, in order to get their debt levels reasonable and to be able to spend money on the other things that they need to bring back manufacturing and reshore for national security and economic reasons. So it's all about the Treasury rate. It really is.
Yeah. And again, the other thing is, it really does I think it takes recession off the table, long term, if we go there. Because again, it's to your right where you went, is the lower rate allows debt burden or people with higher rate debt to refi. That lowers stress, that increases financial flexibility, and it allows people with cash to go shopping. right? The
Yeah,
other side, just, one of the pluses in episode 1 was a 6% 10-year would be great for savers. I think a sub 4% is great for investors, if that makes sense.
absolutely. Absolutely.
Yeah.
Which is why they drop rates in a recession, because they don't want you to save and hoard the money, because then
Yeah.
you're not growing, you're not spending, you're not getting growth back. So the risk is really the opposite. It's we want you to invest and spend. We don't want you to save. We need you to grow. They incentivize you with those low rates. And then what you have to be careful of, this is where, the risk then becomes, okay, it goes from low growth to then, once things are stable and you are expanding, then the balance or risk is more higher rates, inflation again, in the coming years. And so that's where they've got to kind of figure out what's that stable rate that's not restrictive, but that's also not expansive. And so rates are basically the government's way of saying, we want you to save or we want you to invest. We want you to spend or we want you to not. But those of us who are watching, you realize there is power in leverage, and leverage will destroy you if rates are high, and leverage will create tremendous wealth if rates are low. And so that's why you've got to be opportunistic either way, but be really careful. When rates are low, it should be screaming to all of us, lock in long-term debt.
Let's learn that lesson, please. Yes.
So for me, it's all about the debt, and then it's, how do I wisely use debt while rates are low to grow wealth over the next decade or so before the song and dance repeats?
Yeah. Again, when I think about episode 1 in this episode, episode 1 ended with lifetime changing wealth creation, because the pain would just be so severe across lots of areas. I think it's fair to say that a 10-year below 4% absolutely will not create the same level of pain, and thus the same level of opportunity. So it won't be gold bricks and diamonds on the ground like I kind of talked about in video 1, but it will be there for folks who do the work, creative financing. Again, we still have baby boomers retiring in record numbers. The opportunities will be there. They will just be very, very different and probably harder to find.
I'm not sure though, Michael, because I would say when it's high, the wealthy have tremendous opportunity to create more wealth, right?
True.
The average Americans do not. When rates are low, you can start with almost nothing, borrow money to go buy a house that's on sale, right? To buy a fixer upper and a flip. So I think when rates are low, it's easier to borrow money. Banks become less tight. When rates are really high, you already have to have good wealth and good income for banks to lend to you, and even private money lenders, right? But when rates are low, it means a fairly stable economy or stabilizing economy. So after the first 6 months to a year, you mentioned things kind of spiral down, banks start to loosen credit. And so everybody has opportunity. It's really more of the American dream. So there might not be this once in a lifetime, huge wealth creation, but there is this stable opportunity to utilize low rate debt that many, many more investors can actually go and start making deal after deal after deal. The other thing that happens is it loosens up supply. Part of why we haven't had tremendous opportunity to create a lot of cash flow and a lot of value is because the lock-in effect of the low supply from higher rates has kept people from selling. Once you start getting rates into the 4 on a 10-year, again, that's a mortgage rate of about 6%, 6.5, somewhere in there, which is kind of where they are now. You're starting to see some supply come online. If they drop even more, you're going to have more supply unlocked. And so I think there's going to be more opportunity for the broader community to start making really good deals and incrementally, slowly growing that wealth and riding that expansion up.
I think that is so well said. Again, when you go back to episode 1, again, there will be life-changing wealth created. But your point is, I don't know, 1 or 2 or 3% of us will take advantage of that. Right. Because it is, A, we're liquid, we have capital, B, we have experience, and C, we know to jump when everybody's afraid.
Right.
Most people, just like the Great Recession, will sit around so afraid they will be petrified and do nothing. So I think that's wise advice. Again, if we get to sub 4%, I think it's reasonable to assume that with a point or a buy down, we're talking mortgages in the 5%. And I think you're absolutely right. If you want to really see the great unlock in housing, you get to something in the low 5s or something with a 4 handle on it for a 30-year mortgage, you guys are going to be shocked. I actually really believe that if you had a 4-handle mortgage, that prices would go down. Now, why would that happen? Because of the lock-in. We have been so frozen with lock-in with people with 2s and 3s. The first-time buyer doesn't have a chance. The move-up buyer is not playing. We get into an environment where the move-up buyer unlocks, we're going to see so much low-end inventory. The median home price will fall simply because of what median means. It's the middle. Right now, median is artificially pushed higher because we've lost the low end.
True.
Right?
True.
It would be wild for people to think.
Absolutely. And a lot of it, again, it's going to depend on the local market. It's going to depend on your supply and your demand. I mean, there's still markets that are way undersupplied where prices may not come down much, but at least you can get your payment on that property down. So even if prices don't come down and you don't have enough supply to really force that down versus the demand, your demand is going to be so much higher at those low rates because you're simply going to be able to afford the nicer house again with that lower payment, or to afford the rental property and actually be able to cash flow on it. Yep. So, rates can fix what prices don't when prices don't come down to your favor. But there are markets where we're already seeing, at rates where they are today in the 7-ish range, we're already seeing 13 to 19% of houses fall out of contract because people just are like, I'm not sure my taxes, my insurance, my rate. Once you have stabilization and those rates are lower, you get a lot more demand, and that could bring prices down to your point, depending on where supply is.
All righty, folks, this has been a fun conversation building on the success of last week. Do Anna and I a favor. Let us know some topics that you would love to see us talk about both sides, right? Tariffs, both sides, interest rates, both sides. Let us know in the comments below. Where do you want us to possibly take this next week? We would love to hear from you. Anna, you're amazing. Thank you for being so flexible.
Thank you so much. It's fun.